On the 14th of January, Treasury Secretary Janet L. Yellen stated that the United States is anticipated to exceed its current debt ceiling of $31.38 trillion on the 19th of January. If lawmakers do not take action to raise the statutory minimum wage, she will be forced to start adopting exceptional measures on Thursday in order to continue paying the nation's expenses. Debt ceiling and that her options to postpone a default may be limited by the beginning of June at the latest. At this time, the total cash on hand in the United States Treasury is less than $400 billion. In 2023, it is anticipated that the United States federal government would borrow close to $100 billion each and every month. As a response to this, Yellen pleaded with Congress to increase the debt ceiling as quickly as possible so as to prevent further increasing worries about the sustainability of the United States national debt. She cautioned that there was a risk of a complete breakdown in trading on the U.S. Treasury market, and she stated that the United States is facing significant long-term budgetary issues. With the passage of the Second Liberty Bond Act in 1917, the United States government issued itself a virtual blank check in the form of a debt ceiling. Since that time, the debt ceiling has been raised dozens of times. The national debt of the United States was estimated to be around 22% greater than the country's gross domestic product in 2022, when it was at $31.48 trillion on January 14, 2023. It is possible that federal workers and contractors in the United States will not be paid in full if the United States government does not increase the debt ceiling and is unable to borrow more funds. A halt will be placed on not just payments and interest owed by the United States government to holders of its national debt, but also loans made to small firms and students attending college. The Vice President has stated that he would not engage in negotiations on the debt ceiling and that Congress must vote to raise the limit with no further conditions attached. These stances raise the risk of a violation of the debt ceiling, which is a breach that has the potential to result in the United States defaulting for the very first time on its debt. On the 14th of January, Greg Mankiw, who is renowned as the Fed's market expert, gave one more and last warning to Fed Chairman Jerome Powell, stating that the U.S. Treasury market is one shock away from catastrophe. Wall Street, economic policymakers in the United States, and economists are beginning to express concern about the potential for a catastrophic financial and economic disaster in the United States as a result. A default on U.S. Treasuries would have devastating effects on the economy, including a spike in interest rates, widespread fear in the financial markets, and a deepening of the current economic downturn. Thus, Treasuries, the replacement anchor for the U.S. dollar that was created when the country abandoned the gold standard, are the primary driver of the U.S. economy. U.S. Treasuries, which are the primary vehicle for the dollar, are constructed instead on a house of cards consisting of immense debt that has long ago been bankrupt. The overpriced dollar is the only thing that is battling to keep hold of the U.S. Treasuries. It is likely that global central banks will continue to reduce their holdings of U.S. Treasuries in exchange for gold as interest rates on the dollar continue to soar. This is because of the expectation that the Fed's policy rate will be slower, longer, and higher in 2023. As a result of this expectation, it is likely that global central banks will continue to expect higher interest rates. Since May of the previous year, the holdings of U.S. Treasuries by central banks have continued their precipitous decline, while gold reserves have started their ascent. During the course of the last 20 years, public institutions from all over the world have transitioned from being the largest buyers of U.S. Treasuries and bonds to becoming the largest net sellers of these securities. Since October 2017, global central banks have been net sellers of U.S. Treasuries for a total of 49 months, which indicates a drop in investment or a shift away from U.S. Treasuries. Consider the case of Japan, which is the only country in the world that possesses trillions of dollars worth of U.S. Treasuries. There is a good chance that Japan will keep selling U.S. Treasuries in return for liquidity in order to maintain control of Japanese Treasury rates. On the 20th of December of the previous year, the Bank of Japan made an unexpected early adjustment to the objective for its Treasury yield control mechanism. On the 13th of January of this year, the new ceiling for Treasury yield control was broken. This is considered as the beginning of a total end to the BOJ's strategy of controlling the yield on government bonds and the beginning of a full move toward a tightening of monetary policy. Both of these events are expected to occur simultaneously. Once Japan has tightened its monetary policy, it could be one of the sources of the crisis that leads to the financial collapse of the United States. This will cause the benchmark yield on the 10-year U.S. Treasury bond to rise by a sustained 100 basis points, which will set off the U.S. Treasury market. If Japan has already tightened its monetary policy, it could be one of the sources of the crisis that leads to the financial collapse of the United States. On January 13, Dr. Doom Nouriel Roubini predicted that U.S. stocks might collapse by 25% in 2023. He also stated that there is a greater need to be aware about Japan being a black swan for U.S. Treasuries, given that the United States is moving into a debt crisis. The financial markets in the United States are already in the midst of a repeat of the financial meltdown that occurred in 2008, and they will be hit by a severe recession, severe debt and financial crisis, with catastrophic returns on U.S. bonds. In 2008, the global financial system experienced a meltdown that was caused by a combination of factors. Since 2022, Japan has sold a net amount of at least 240 billion U.S. treasuries. As a result, the country's holdings of U.S. treasuries have significantly shrunk, going from 1.303 trillion in January of the previous year to 1.078 trillion at the moment. The market anticipates that Japan will most certainly keep selling U.S. treasuries in 2023, with the total amount of these sales reaching as high as $900 billion. After the Bank of Japan ends its policy of negative interest rates in 2023 and begins to gradually raise rates, any action by Japan before that time will result in a rise in the yields on United States Treasury securities. All of this points to increased volatility in the U.S. Treasury market, which, in the end, will turn the roughly $24 trillion U.S. Treasury market into a nuclear bomb that will detonate the U.S. financial system and become the source of the subsequent round of U.S. financial crisis. And because U.S. Treasuries are the most important asset class in the country, Yellen's declaration of worry over the stability of U.S. Treasuries will also have a direct influence on the Federal Reserve's tilt toward a more hawkish course of interest rate rises. Because of this, several financial institutions on Wall Street, including Goldman Sachs and Bank of America, have continued to wager that the Federal Reserve will eventually cave in the face of the difficulties faced by the United States Treasury. Before inflation can be brought under control, the central bank will have to give in, abandon its plan to tighten monetary policy, and begin to adopt a more dovish stance. According to this point of view, the three crises that Japan becoming the black swan of U.S. Treasuries, the soaring cost of U.S. debit, XCL rating, U.S. Treasury defaults, and the continued net selling of U.S. Treasuries for gold by global central banks will probably lead to a financial collapse in the United States in an environment where markets fear that a deal on the United States debt ceiling will not be reached.